The Sensex was in last 45 years has given return of 1200 times.
When is it easier to make money, back then or now?
I would say it would be probably relatively easier. Some of the mutual fund units were listed also. During the peak, they were listed at 8-9 times the NAV.
Wanted to understand what is your style of investing?
Mr. Market rate is supreme and no one can say, we are lesser mortals and you have to constantly learn here.
Neelesh, let's talk about your funds now. In this episode, we have with us Mr. Neelesh Surana, one of the famous fund managers in India. He is the Chief Investment Officer of Mirae Asset Mutual Fund. He is an engineer by graduation, but settled in the fund management industry because of his interest in the stock markets, which he has been following since his childhood. He joined Mirae Asset Mutual Fund in 2008, since the inception of the fund house. Apart from overseeing all the equity schemes in the fund house, he manages two flagship schemes: the equity-linked savings scheme, and he also co-manages a large and mid-cap fund which is earlier known as a emerging blue chip fund. He says that his focus is on picking quality stocks. Now I'm going to him as a market rookie and understand his style of investing. Let's join. Thank you so much for joining us, Neelesh.
Thanks, Satya. It's my pleasure.
With equities being the hero asset class in the last few years, there are a lot of first-time investors that joined markets, started investing in mutual funds for the first time. And I'm here on behalf of that rookie investor to understand your style of investing and so many things about market. Before we start, Neelesh, I want to understand this. How are market conditions different when you started off? I've read somewhere that you dabbled in stock market investing pretty early in your life. So how are market conditions back then versus for me, a rookie investor who started investing only in the during the bull market in COVID? So how is it different?
Yeah, so if you're referring to my college days and when I was analyst on the broking side, the 90s or early 2000, there were a few differences. One is if you're asking from an investor or analyst point of view, I think back then, back then I would say that there was both information arbitrage and analysis arbitrage, and markets were relatively more inefficient. What I mean is that the information availability has changed dramatically in last couple of decades. Now, most retail investors have access to most of the information digitally, and the regulator has also given a lot of options. You get conference call, you can attend call, you can get transcripts. So information dissemination availability has changed big time. So there is no arbitrage. Earlier, getting access to annual report or analysis was very sort of different back then. And related to that, the analysis part also has evolved because the institutional mechanism has evolved, markets have matured, sell side, buy side, firms have evolved. So I think that is one area of difference. Second area I would say is that I think the opportunity landscape has changed. Earlier, a couple of decades back, you had more so-called old economy or manufacturing-oriented businesses. These days, there is more technology-oriented businesses, as well as there is a linkage to the global markets. So I think these are the two sort of differences I can call out compared to the previous sort of periods. And so on the positive side, you have more information and more data tools available to analyze. And maybe slightly more challenging is that so much of noise or maybe different set of businesses. So I don't think it makes it so difficult or hard. It was harder then also and even now, because you have certain tools more available now.
No, but tell us, when is it easier to make money, back then or now?
No, I see there are the time-tested principles of investing good quality at reasonable price was available then also and now also. I would say it would be probably relatively easier then because the industry was not as much evolved. So those who understand it, if they are asking that if the same set of investor, it would have been easier. Reading annual report would get an edge back then, which now probably, as I said, so many tools, so many software, and with social media and various channels available, I don't think you have so much of information arbitrage. That's why if you see back then there were the inefficiencies were very glaring. Let's say during Harshad Mehta boom time, at that time I was student, but there were cases where some of the mutual fund units were listed also. And you will be surprised to know that some during the peak, they were listed at 8-9 times the NAV. And during late 90s, I recollect.
That was the time when mutual fund units were listed.
Yes, listed. Only couple of mutual fund houses were there. So it was like a 10 rupee note being traded at 80-90 rupees. It was as inefficient as it could get. I've never seen a bigger sort of example of in market inefficiency. I think those have not sort of, that note has become, these are like very obvious ones. The markets have matured, ecosystem has matured. But that said, the investor behavior of greed, fear, and cycles, that was then also, and now it's relevant now also.
But I'm going to take that it is much more difficult for me to make money now in the markets than it was to you. That Harshad Mehta scam, Neelesh, what were you doing back then when you got to know that happened, when that incident happened, and did it have any impact on how you are looking at markets back then?
No, so I was student. I was an engineering student, and then so at that point in time, obviously it was something which was very exciting, because in short period of time no one would have seen it, and we were not in Mumbai. I was from a smaller town, so you always get perplexed tracking the market. I used to invest smaller sums in IPOs or so. But I do recollect the instances I mentioned about, let's say, a mutual fund unit traded at, because we happened to invest in that 7-8x the NAV. What to do was very perplexing, and we have seen instances. There were a couple of allotment, and you not believe, and that's one I have sort of experienced. An NBFC company, by the time the allotment used to come and listing used to happen, back then it used to take 2 or 3 months, and it is some 30x in 4 months. I mean, those sort of, in fact, that gives a bit of fascination that what is this industry about. But we were just an observer in a smaller town, just trying to.
There was no internet at all, so how did you get all this information?
Yeah, so there was traditional ways of phones and newspapers, and there were a couple of publications and magazines like Capital Markets, The Last Street, and all.
Got it. You touched upon access to information. Now, yes, we have a lot of access to information. And talk about workshops. If you see one YouTube video, there are at least 3 ads. Even experienced, non-experienced, everyone are doing workshops on stock markets. That's a different thing. What was your source of information back then when it comes to markets? How did you learn about markets?
No, I've shifted gears in terms of my career. I did my engineering, then I did my finance, and then came to Mumbai. So the learning curve is very standard, that either you join a sell side firm, which is a broking firm, and you cover a few sectors, or you join a buy side, which is an asset management company. Back then it was not very small sort of industry. But the source of learning is on the job. I mean, not as an investor, because that's more like a hobby or so prior to that. But as a professional, as you join I was on the broking side. I covered few sectors, and then subsequently were interested towards money management or so. So shifted gears and joined a buy side, and then I mean, then there's on the job learning, and also you learn obviously by reading. You learn from various industry peers, various experts are there, and it's a journey, and we're still learning.
Yeah, they say that markets, it teaches you every day.
Yeah, Mr. Market is supreme, and no one can say, I mean, we are lesser mortals, and you have to constantly learn. Yeah.
Sure. There are so many ways, at the end of the day, food is there to actually satiate our hunger. But there are so many cuisines out there that one can, prepare the food in. Or investing per se is for wealth management or wealth building. But there are so many styles of investing. Different people follow different styles of investing. Wanted to understand, what is your style of investing, Neelesh?
Yeah, so Satya, as you know, we are in a very institutional sort of setup. We are managing 1,90,000 crores of assets. So it's a very institutionalized sort of template rather than my particular sort of style. But that said, to answer your question, I think the broader style, I mean, we can call it growth, value, blend, or contrarian, etc. The core of the style is is related to how do you identify businesses which can create wealth in the longer term. That's the crux of it. And within that, you have to buy good quality businesses and at a reasonable valuation. I think that's the style, no matter how you package it, because equities is about growth. So obviously, you look at a growth vertical, character of growth in terms of ROE, good management, and reasonable valuation. But yeah. So one is you have to buy quality business, and one can define how you identify quality business, which has a growth factor, which has a return on capital employed factor, and also qualities associated with the management of the company. And then you don't have to overpay for it. Now that's the basic concept of stock sort of selection, and we can package it into various style, whether it is contrarian investing and all, but I don't think this basic sort of changes. And if you time test, let's say if you pick up any particular stock which has good quality, good growth, and if you have bought it at a reasonable margin of safety, invariably you'd make money. So that's the core style which we also follow.
So we can say that the focus is more on the quality of the business. Like
absolutely, and not overpaying for quality. That's also quite relevant. Yeah.
I want to understand, like, there are, as you said, there are different styles. Of course, the basic premise of all these styles and the way of picking the stocks is the same, like looking for companies which are, well-priced companies and good fundamentals. But is there one style that consistently performs in all the market conditions? Because they say that each style has its own pros and cons. Each style will go in the one market condition and drops in another market condition. So is there one style that you think, or the quality style, does it has the ability to outperform in all the market conditions?
No, so if the lens of evaluation is, say, near term, 1 or 2 year lens or 3 year lens, then generally consistency of style and consistency of performance may not go hand in hand. But yeah, if you are, let's say, following, you're essentially look at certain growth filters while identifying a business, and then a more growth oriented portfolio, and someone is slightly more looking at more margin of safety. I mean, growth is important, but you're looking at more sort of value parts. So if that be the question, that growth and value, if these are the styles, then you will have markets which have various cycle. But as long as I said, the crux is that if you're buying quality at a reasonable sort of price, then over the longer term, let's say 5-10 year, I think that style would perform. More important than this basic factor, that quality at a reasonable price, which most of us money managers would say, is how you execute it. Because there can always be errors. Despite having a framework, either you would have bought something which has not worked, or you would have missed something which would have worked. So I think it's slightly more to do with execution in terms of performance or not performance in a period of time. Otherwise, template wise, as long as you are buying good quality at a reasonable price, and having a very risk-adjusted portfolio construct, that's another element of portfolio construct. And then I think that style would work in the longer term. It has worked in so many past decades, and it would continue to work.
What is risk-adjusted return?
No, risk-adjusted return, I am referring to, one we talked about till now more on stock selection, which is which business, good quality business, and the way to define quality is growth, return on capital employed, good management in terms of thought leadership, ability to capitalize on growth, and reasonable valuation. All these three factors are related to stock selection. When I say risk-adjusted return is more on the portfolio construction side. Irrespective of how many filters you have used, how much research you have done on a stock, you can still go right or wrong, right? Not necessarily you can go right, because sometimes assumptions change. Sometimes external assumptions change. Sometimes your assumptions can go wrong. So the way to mitigate is to have a portfolio of stocks. So when I say risk-adjusted return is how you construct the portfolio, and
with a bunch
of stocks. And if you are constructing a portfolio in a very disciplined manner and in a very risk-adjusted, you keep taking care of diversification. In our case, we also look at the benchmark, how much you are deviating from that. So all those nuances is what I mean. If you are doing that, and what happens, Satya, is sometimes, as I said, sometimes the stocks may not do well, or they may momentarily not do well. There can be quotational loss. But during that period also you have to perform. So if the portfolio construction is very well thought out, then the overall returns will be better in terms of risk, drawdowns, etc. Because it should not happen that a particular call or a particular style or a sectoral call or a stock call should impact the overall performance of the portfolio on the risk adjusted returns. It should have less volatility and it should have fairly consistent return over the benchmark.
So when someone comes and says the stock I have invested in has given 2x returns, 3x returns, we have to ask, what is your portfolio return?
Absolutely. And also over what period of time? Over
what period of time?
Yeah.
Got it. So let me just reiterate, Neelesh. So you're saying that when it comes to stock selection within the portfolio of stocks that you are managing, you look at the quality, how the business is doing, how the valuation is, how the management is, everything. But you also have to take care of the portfolio level because it's a bunch of stocks that you are investing in. You also mentioned that you look at benchmark. Can you elaborate on that?
Yeah, so see, the mutual fund industry has evolved, and as per the various, if you look at the fact sheet, you have to compare returns vis-a-vis the index. When we talk of index, whether it is a Sensex or Nifty, you have to, and just to give perspective, let's say Sensex was in last 45 years has given return of 1200 times. If you look, including dividend, total return index,
1200 times.
Yeah, which is about 16% compounding over a 45-year period. Now the question is, investors these days can invest either in passive funds or they can give money to active fund managers like us. So our mandate is to outperform the benchmark consistently. Otherwise, investors can also invest in the benchmark, which is the Nifty or Sensex or other benchmark.
So if the Sensex had given like 16% per annum CAGR, the annualized return of 16%. So if we are coming and investing in active fund managers, we expect something more than 16%.
Yeah, and that's what I was referring to. You should not have a significant divergence with the benchmark in terms of return category. Also a risk, yeah.
Oh, okay. So even your portfolio of stocks also reflect how the benchmark is?
Absolutely. So the portfolio should look at the benchmark stocks. More importantly, the sector weights in the benchmark. So what we do, we have to deviate from the benchmark to generate alpha, right? And also to be in sync with our investment philosophy, because not all benchmark stocks would fit in our investment framework of quality, growth, valuation. So in that context, there is slightly more nuanced that we deviate from the sector weights and take a risk-adjusted call. You don't deviate significantly, but we deviate appropriately.
Can you give one example?
Yeah, on how, let's say for example, banking sector, it would have a weight of say 30% in the large cap index and the large cap benchmark. It may have a weight of say 22% in the mid cap benchmark. And if the fund manager is same, and the view is same, which is say positive, so he would, if he is going overweight in a large cap fund, in our case as a fund house, generally we will go about 30% in the large cap, but not about 30% in the mid cap, because the benchmark weight is 22%. So the over and above benchmark weight is called the deviation active weights. How much weights you are taking, or how much you are more positive compared to the benchmark. That is one part of it, which is called sector weights. How much you are investing. It's called overweight and underweight.
Why can't you take more deviation?
Yeah, so that's what I was saying, that calls can go right, calls can go wrong. So that's where risk come in, because we have to outperform the benchmark, right? Now, second part of it, which is more important, is which stocks to select. So herein, generally, we take much more deviation. You don't have to buy all benchmark stock. You don't have to do benchmark again. You have to buy stocks which you like in terms of the fund house research, the fund house investment philosophy. Within banking also, there are certain names maybe you will not like. You will not buy those sort of companies. In our case, we deviate more at stocks level and deviate less at sector level.
Okay. For example, if Nifty 50 has about 30% weightage to banking and financial services companies, so you may stick to around that 30%.
Yeah. So if you are positive, if you are positive, then it has to be more than 30%.
30, slightly
Otherwise,
more than.
How do you outperform the benchmark? So it can't be that I like banking, but I am 20% and the benchmark is 30. So one level is that you have to be more than 30. And second is also that which stocks you buy. If you see over last decade, couple of decades in India, you see a lot of divergence within the sector. Within the sector also, you see different scale of wealth creation, because that's a function of the underlying business, the underlying management. Each stock has different management, and then what price you are entering. So that's where the house research come in. In fact, we have a concept just on this, slightly deviating, but related to this. we have a concept where analysts are running a sector neutral portfolio. So what they do is they don't take sectoral call, but they identify the stocks within the sector from the benchmark, different weights, so that they can outperform the sector weights. So that's basically stock selection, in our opinion, is very important. But from risk perspective, no sector, stock, style, theme should be very differentiated from benchmark from a risk perspective, right? If you are taking, what I'm saying is if you are deviating significantly from the benchmark at a sector level, say 30% is the, we took the example of banking, 30% is the weight in the benchmark. If you're taking, say, you're negative, you're taking 15% weight or 45% weight. What if certain calls don't go right, or first go wrong before getting right, something like that? Then it is lot of volatility is there, which causes riskiness to the portfolio. Yeah, that said, while we talk so much on benchmark, obviously we would not do any benchmarking if we see absolute downside. There is a fiduciary element, right? We are managing people's money, and so to that extent, you will not do benchmarking knowing that it will fall less or so. So all benchmarking is done only when, in our assessment, that particular stock has absolute upside. And within that, we pick and choose which has higher upside, which is better, which is a better sort of this metrics of business and management, and sometimes which are slightly differentiated from within the sector also. More diversified plays, yeah.
Understand. So, I mean, firstly, stock selection, as I'm repeating, the growth quality stocks are quality stocks with emphasis on return on capital employed, as you mentioned, and other quality of the management and the valuations, you look at that. But again, when it comes to portfolio, you look at all these, how the benchmark is, how the sector weights are, and then within that sector, you play around the stocks weightage to generate that alpha. Alpha is nothing but the difference between the index return and the return that the fund has generated, the extra return that the fund has generated. Got it. Now, how important are these sectoral calls? Now, I understand as an individual investor, I can actually research a company better, but do I also need to have this sectoral calls right? And how is it important for a mutual fund manager like you?
Yeah, so I mean, say as an individual investor, see what happens, sometimes you pick up stocks in isolation and you're not able to make a proper psychographics of the portfolio, which can reflect all the opportunities and which can be slightly de-risked also. A trait of X stock, X should be different from Y. If you're buying all the stocks from one sector, you're taking more risk, right? At an institutional level, the stock calls are extremely important because at the end of the... sectoral calls, I'm saying stock calls are very important. But when I said sectoral calls is, I mean, while we are a bottom-up sort of approach is there, you focus more on stock, but it can't be looked in isolation with a sector. First, sectors have to do well. So what we do, obviously, you look at sector is basically businesses which can create wealth. So first, the business should create wealth, which is basics like growth and ROCE. This is the basic two sort of filters. You can quantify it. Let's say in our case, we look at business should grow at least slightly higher than the nominal GDP growth. If the GDP growth is 12%, it should grow at 15% or so. Higher the better. Of course, 20-25% higher the growth, better. Second is the character of growth, which is return on capital employed, is also largely same for a sector. Right? If a hotel, plot of land, if you have a hotel, you have certain return on capital employed. Same plot of land, if you make someone is running a hospital chain or diagnostic, it will have a slightly different return on capital employed. So the band of return on capital employed is more similar sector wise. Within that, of course, you can have more efficient company and less efficient company, but generally. So long answer, but sector identification is to understand that that business has ability to generate returns by way of superior growth and good quality growth as identified by ROCE. That's the importance of sector sort of selection.
Moving ahead, I've also heard that, Mirae Mutual Fund is also known for taking contrarian bets. So where does taking this contrarian bets is nothing but when everyone is buying, the fund sells, and when everyone is selling, the fund buys. So how does this contrarian bet fits into this stock selection, sectoral calls?
So contrarian bet is basically your special situation or turnaround or something which people are ignoring and you attempt to look at it.
Can you give one example?
Yeah. Is when we said the stock selection has three verticals: business analysis, management analysis, valuation part is where in general contrarian there is a mispricing because not many people are looking at it. You have to look and understand it, but you don't have to be contrarian for the sake of contrarian. What happens is sometimes, at least I can talk about our experience over the last 17 years, you see certain businesses, they go through a tough patch. And there the near term is impaired, but long term is intact. And they may be blue chips, they may be sector leaders, but they may go through a bad patch where, let's say, the largest auto vehicle, I'm talking about more than a decade back, there were multiple strikes, there was fire, and then of course the earnings, near-term earnings came down significantly, and no one knew when it would turn around, but it would definitely turn around because it's a very strong franchise and they're going through a rough patch of few quarters or few years in some case. That times generally markets slightly have some myopic thing. Many people are not interested. The stock prices correct disproportionate to the franchise value of the business. So when the business is not doing well momentarily, as I said, near term is impaired, but long term has to be intact. Not everything which is 52-week low is contrarian. Good quality contrarian opportunities come rarely. More so in this market, if we started with COVID, and then of course we have seen one-sided market for the last 3-4 years. One of the ways to then you will not get good businesses at reasonable valuation because markets are efficient, so much money is chasing it, you will never get quality cheap. One of the ways of looking at the valuation is special situation when others are not looking at it because near term is impaired and sometimes there is anxiety then when it would turn around. So a pharma company having some FDA issues which may not impact entirely or for the entire period of the business, or I give example of certain strikes which is happening place, or maybe there are some company related changes, leadership changes, or many a times the sector may be passing through a bad patch. Or sometimes a style may not sort of do well. The classic case is many of the government companies, PSUs and all, they were available 4-5 years back very cheap. $1 for 50 cents, 30 cents. They were equally good cash generating growth. So many a times those contrarian opportunities take care of the third part, which is the valuation part. In that case, the margin of safety is generally high. What happens is, suppose the value of the business is 100, if it is not doing well momentarily, it will not fall to 50. Value of that franchise as a full owner of business will 100 may become 90, but the stock price will come down by 50%.
What do you mean by margin of safety?
Margin of safety is your assessment of value of a particular stock.
Okay.
And what is the price? Price is known in bottom of the market. The difference between the two is margin of safety. You will buy only when your assessment of institution, house, fund manager is more than the price. Then only you will buy. That is the margin of safety. If the stock price is 100, I will not buy if my assessment of the value of the business is 80, which is the present value of future cash flow. So you will buy when the value of assessment is much higher, right? The difference between the two, if it is very narrow, if it is only 5%, then many things can happen. Assumptions can change. My assessment can go wrong. It's not that nothing is that our assessment has to be right. And to that extent, but the margin of safety is very high. If you are getting $1 for 50 cents, then there is a lot of levers that even if you go wrong, or even if it takes more time, the franchise value of business is significantly higher than the current price. So you have very strong case of taking low risk and when the mean reversion happen, high returns. That's a classic case, very decent. Yeah.
So far we've discussed about stock selection, looking at sectors, and also looking at contrarian bets and the opportunities available in the market. I mean, if I have to ask for you as a fund house, what really worked well? Is it the stock selection, or is it the sectoral bets, or is it the contrarian bets, or is it a mix of all? Like, what really worked?
Yeah, while it's a blend, but I think it's more towards stock selection as a fund house, and I'm taking liberty to answer on behalf of my colleague fund managers. I mean, we have completed 17 years. Actually, first 15 years was fairly satisfactory performance. Last couple of years, while it is not as good as first 15 years, but what has worked well or not worked is more to do with stock selection rather than sectoral call. And as I mentioned earlier, that we generally don't take very aggressive sectoral calls.
As a retail investor, so will a retail investor, an individual investor, will that investor be successful if they just stick to the stock selection and not look at sectoral? calls?
No, if you're talking of a retail investor who is investing on the own, I think it's slightly, I have different views that it's not so easy. Of course, right now the market is doing exceptionally well, but there are various biases which come in, and it's not so easy to invest. And I don't think only picking stock can sustainable help a retail investor, because you need to construct the portfolio. You have to look at the psychographic of the character of the portfolio. It should have a representation of all good businesses. Otherwise, you will miss certain opportunities. So only picking stock without seeing the whole portfolio in toto, in terms of its growth, in terms of its diversification of business, the type of management, all that is important. So only stock selection, I don't think it may be good momentarily when the markets are doing very well, so everything is doing well. But from a longer term wealth creation perspective, it's better to look at the entire portfolio rather than one particular sort of stock. I think full-time investors can attempt to do it. Have you said there is enough information available, but it's a tough ask, because just see. Most institutional setup would have a battery of analysts, fund managers, and their full-time job is that. So full-time investors can do, but an individual investor, I think, will have slightly more difficulty. I'm not saying in terms of aptitude, is maybe you don't have that quality of data or that extent of data. And by the way, whatever I talked in the previous question or so is more about our own research, which is the primary research. In addition, we are also getting secondary research. Many of the top broking firm and their analysts are also sort of servicing or sort of communicating with us. Now, an individual investor would not have access to all the brokerages, or you may get report late, or you may not get it in the entirety. You may not get access to the management. So I would suggest that I'm talking of a basic investor, it's better to leave it to the professionals. It's always better to leave it to the professionals, because there can be various biases. If you are investing, you can get stuck with your cost. But as I think, things are very dynamic. And to that extent, it's very difficult, unless someone is full-time investor and who has been here and is passionate to do that, then of course he can attempt to sort of do it. Otherwise, it's a bit difficult.
Right. We see this happening anytime when someone, starts their investing journey, maybe in direct investing or maybe technical or trading as well. When they start with small amounts of money, they may make actually good amount of returns. But as the capital grows, it becomes really tough. I mean, I totally understand the different set of processes that one has to go through to actually maintain that set of investments already made. For you maintain about 1.9 lakh crore AUM. So how difficult is it as the investment amount grows?
So it can't be looked at in isolation. The amount is to be looked in context of how the country has evolved, how the markets have evolved. The market liquidity, number of companies, scale of companies have increased significantly in last couple of decades, and definitely even in last 5 years. So you have to see, we can't look at 1,90,000 crore. You have to look at the scale of the market cap, which is closer to 5 trillion. So to that extent, that is one angle. Second is, this is not one single product, one single scheme. So there are more than a dozen schemes, meaningful schemes, and there are different fund managers. There are different mandates, and to that extent, we have to look at that. Third is, there are various risk guardrails, measures, liquidity filters, all that has to be done to manage such large sort of size of AUM.
Got it. Now, there are so many things to consider now, Neelesh. Like, how don't you get overwhelmed? I'm like, how do you go about, the information available on stocks, and then the portfolio construction and portfolio risk management? Like, especially when it comes to information about stocks, there are a lot of information. There's a lot of information available out there. Do you get FOMO anytime?
Well, like, see, as we were touching on the individual investor and all, they also get information, but you don't know how to filter out. It's not difficult. That's why I always suggest that I'm diverting. I will come to your answer, but is that individual investor should ideally have core portfolio of funds, and then he can have some tactical or positions in individual stock, but can't manage the entire portfolio because of so much information and all.
Okay, say suppose there is 100 rupees that the person has. You're saying
you should most of it
should be in mutual funds where it is taken care by the professionals.
Absolutely, yeah.
And the rest of it, like 40 rupees, 30 rupees, you can
Absolutely,
dabble and
because
do
I mentioned that look at the index itself, which and many funds over the last 2-3 decades have done much better, right? And when saying index has gone more than 1,000 times in 45 years, which is 16-17% compounding, I mean, that itself is a very sort of powerful sort of number to why not to participate, because the product is very transparent, it is very tax efficient, and it's very competitive. There are more than 40 AMCs, everyone wants to be in top quartiles, and who is the winner is the investor. So I think it's a beautiful product to have at least a core allocation. But in addition, if someone is interested in stock, then he need to give some time, and then probably he can have more of sort of, I'm not talking of full-time individual investor, that is a separate, but they are far and few. We are talking of large section of investor. I think mutual fund should be the core vehicle to sort of create wealth. And to your earlier sort of question in terms of information, but that's a part of that information is available to everyone. You have to filter the information. Some of it is noises, because see, Satya, what happens is we as an institutional investor, you have a time frame which is slightly longer term, right? We don't look at 2-3 months or so. You look at 3 year, 5 year and beyond. So the information also needs to be seen from that filter. We are not traders, right? So you don't have to analyze each and every piece of sort of information. So to that extent, there are ways and means to sort of filter the right set of information and attempt not to get too much influenced by noises. Yeah.
Neelesh, let's talk about your funds now. I mean, the funds that of course, you as a CIO oversees all the funds, but directly manages the ELSS, which is the Equity Linked Savings Scheme, and also co-manages the large and mid-cap fund, which was earlier famously known as Emerging Blue Chip Fund. Look, why don't you talk about these funds? And you follow the same style as you mentioned earlier in these funds, the quality aspect?
Yeah. The house template is sort of same, that we decide, the outliers are decided in terms of not to participate in suboptimal quality businesses or management filters and not overpay for it. So that's the house stock philosophy. So these two funds, as you rightly said, the erstwhile Emerging Blue Chip was launched in July 2010, so it's completed 14 years. And it has seen the category change to, earlier it was a mid cap, now it has become large and mid cap. Very beautiful category. It captures both best of large caps 50% and best of mid caps 50% allocation. Excellent category, particularly in current context. And the ELSS is something which is, I think it has a 3-year lock-in, which sets the time frame, mind frame also. 3 year is minimum time frame required in equities. Yeah. So these are the two products which have slightly different benchmark, but there's a lot of commonality in terms of sector overweight, underweight, and the stocks. Emerging Blue Chip, or the large and mid cap, is co-managed by Ankit Jain, who is managing all our mid cap strategies.
So for someone who is following a quality style, or in your case, people who are investing in these funds following a quality style, both ELSS and large and mid cap, like what is it that something that I can expect, Neelesh? Is there any one particular trend that you have seen in the past that these funds or these styles perform during these market conditions, may not perform during these market conditions? Is there anything as such that we can expect?
No, so in terms of returns, both the products are like, the second product is a decade, almost touching decade next year, and the first one is 14 years. So for the large portion of time, let's say in the Emerging Blue Chip, the now large and mid cap first, barring last 2 years, we have had fairly satisfactory performance over the benchmark peers for first 10-12 years. So as I said, the approach is sort of same. So I cannot single out one certain sort of factor. It is that we would avoid a business which is not quality, will not overpay for it, will not chase momentum. That is one part. We don't shy away from taking contrarian opportunities. That's another aspect. And it has to be a risk-adjusted, diversified portfolio which can generate decent return over the longer term. So that's the same sort of framework as a house, and even definitely for these two products.
So you are aiming a consistent performance over the years.
It has not happened in last 2 years.
Yeah, but the
but
aim
it did
is
happen.
to...
But if you look at a 10-year number, then definitely it has been there.
When we say consistent, what is consistent?
If you, as I said, that the consistency of investment style and the end result of performance may not go hand in hand. You can have a fund which is doing exceptionally well in, let's say, market like what happened in last 2 years, and probably prior to 2 years period it would have done exceptionally bad. So to that extent, there can be a lot of anxiety to the investors. The end results may be same. See, 100 may become 200, but one can go 2 years very good, 1 year bad, 1 year very good. The end result may be same, and one is slightly more vis-a-vis the benchmark. So the attempt is to be in the second bucket. But as I said, it is an attempt or objective which most people would like to have, but it's slightly difficult to.
Makes sense. Absolutely. Got it. Now let's talk about your team, Neelesh. Mirae Asset Mutual Fund is owned by a South Korean company. It's a parent company, is a South Korean company. So how's the culture here? I mean, we've heard about South Korean, office culture where it's very hierarchical and too many distinctions between the, different sections of the office. So how is it here in India office here?
No, so we are lucky to have a sponsor which was given a lot of freedom, and to that extent, the ecosystem of the framework is left to the domestic sort of team, which is led by Mr. Swaroop Mohanty, who is the CEO. So from an investment team perspective, there is enough and more sort of scope to a freedom given in terms of how we have sort of set. So we are run independently in that sort of context. And you asked about the team and also, as I mentioned earlier also, that we have a 18-member team on the equity investment side. There is a separate team for fixed income, there's a separate team for passive. I am talking about the active equity funds which we have been talking about. And as we have been discussing for now is, I think this business, when you look at active fund management, is about people, processes and philosophy. But essentially, it's about people, because it's the team or the people or the investment professional, they will set the investment philosophy and they will set the processes to meet the guardrails of the investment philosophy. So it's very important to have a right set of team and the individuals, professionals, analysts, fund management, and the execution dealing team. In that context, as I said, I mean, headcount apart, it's more to do with the experience of the team, the culture of the team. And I can say, I mean, been lucky that apart from sponsors and CEO, the team is, I would say, is quite a good blend on multiple aspects.
You go outings and all?
That is there, that I will come to that. But more, let's say, if I stick to the overall experience, it's a good blend of young talent, and very experienced professionals. So it gives a different perspective. Then most people are very passionate about the job they are doing, whether they are covering sector, they're managing funds, because the business has challenges and all. So unless you are passionate, you will not sort of work. And then, of course, as you rightly said, the culture is very important. There has to be collaboration, there has to be team effort. So I would say culture is very collaborative, it is very congenial, very collegial. So all aspects are fairly sort of satisfactory. Yeah.
What do you see?
And it has, by the way, it has changed significantly over the years, because it's a process and you have sort of strengthened the team.
Got it. So can you tell me what changed? At least one example.
In terms of, in this last 5-7 years, we have increased. I mean, as a new people, existing talent has evolved. They have taken higher roles. The team has expanded. When I change means it's not to do with attrition. It's more, it has expanded. Yeah.
What do you see in the young investment professionals that join the team? How was it earlier and how is it now?
So we cannot generalize, but I think I personally, or as I mean, we give a lot of emphasis in terms of the softer aspect, because whether it is young or middle age or so, particularly in investment professional, the individual aspects are very important in terms of teamwork, passion. As I said, this profession needs a bit of extra effort. I mean, you are left to, it's left to an individual to capitalize on the opportunity of learning and sort of things. So those aspects has less to do with age and more to do with an individual.
So you see the software aspects more than the talent in
both
the
are
investing?
equally important, but software aspect is extremely important. You have to institutionalize the team. You have to institutionalize the framework. Then, as I said, collaboration is important. what set of processes are there between the analyst and fund manager? What are the protocols? What are the processes? How do you manage that? So we have many processes. We have concept of gatekeepers, and there are many sort of processes. But at the end of the day, it's all sort of teamwork. So to that extent, it's been very satisfactory in terms of how the team has shaped up.
Neelesh, you mentioned that institutionalizing the framework a couple of times. What is that? Like, what is institutionalizing?
No, I mean, we mentioned that you are managing close to 1,85,000 crores, large scale, large size, so many folios, and the team strength is there. So when I say institutionalization is of the research process and also on the fund management side. So let's say there are senior fund managers. Gaurav Mishra is there. He's managing 2 large funds. Then we have Ankit, who is managing all the mid-cap strategies. We have head of research, who is managing few hybrid funds. Then we have 3 thematic fund managers, Brijesh on the healthcare side, Gaurav Kochar on the BFSI theme, and we have on the consumption side Siddhant. So I'm saying the overall team structure is not dependent on a particular individual or so. So to that extent, it's very de-risked. And also, the way stocks are selected and the discussions between analysts, fund manager, most of the things is an attempt to make it more sort of process oriented. That's where you can sort of say it is more of an institution rather than dependent on few people.
Neelesh, let's talk about the performance. I mean, if you see the fund's performance of the funds managed by you, especially in the first few years, 15 years, it has been like given tremendous returns. They are one of the star funds in the industry. But of late, there's been some lag in the performance. Of course, even now, if we look at the long-term performance, someone who is invested 7 years, 10 years back, they would have had like tremendous good returns. But at least for someone who is invested in the last 3 years till 5 years, they would have seen slightly underperformance. Why is that so? When the process has been the same throughout the years?
No, you're absolute right observation. So last 2 years performance has a bearing, even it's flowing up to 3-5 years also today. So, but most of the things happened in last 18 months and last 24 months, 2 years. I would say that any point in time when the funds were doing well also, there are always 2 categories of errors. What we missed, which is called errors of omission, which has done well, and what we own, which is not doing well. I mean, all fund managers will have, extent would vary. Some, not all calls can go right. So that, of course, get camouflaged and the returns net is better, as you mentioned in initial sort of period. But last couple of years, what happened is our error of omission got amplified. Some of the industrial sectors like capital goods, defense, power, some of them we were either, we bought early, but we either sold early, we were slightly conservative, or we didn't participate as much. We never thought that it got re-rated so much.
Sectoral.
It was slightly more to do with those particular sectors. So we had less representation, or we would have sold early. And it is those sectors which really did exceptionally well in last 18 months to 2 years, to the extent that some of them went 3x, 8x, or maybe some of them has gone much more than what they are warranted, and they can probably correct. So we can probably first go wrong before going right. But net, the errors of omission impacted the performance. It's not that absolute returns or the portfolio diversification is not there. So these are learnings. And of course, there are certain names which are not doing well, which we own, which is errors of commission. But that I would say most of it is quotational. So that quotational. Quotational means, in our opinion, these are good businesses, but they are not getting re-rated, maybe because there may be few quarterly challenges, few management challenges, something like that. But it's not permanent loss of capital. Permanent loss of capital is a wrong business, wrong management, or paying very high price. In our opinion, most of the stocks which are not doing well are, I would say it more like quotational sort of cases. But long answer, but if the underperformance is more to do with what we miss, which I said is always there, but this time it's got really amplified. Extent is always there, and it's there for everyone, right? So you can't catch all the winners, and you can't have not a single sort of.
I've seen one of the videos in which it says quality stocks may not perform really well when the bull market is on a rage and when the momentum stocks are doing really well. Is that the case here? So can we say that since in this market, every other stock is going like going up so high, does the quality stop?
No, that is, yeah, I got your question, but it's not that we bought quality at any price, so which is impacting us. We have been very cautious on the valuation. But you are right that what has done well in particularly in last 18 months, from March 23 onwards, last 20 odd months, some of the sectors have done exceptionally well, right? And the verdict is out in terms of not yet sort of final that whether the kind of re-rating we have seen in, let's say, capital goods, infra, so sort of names would probably sustain or not. So yes, many of those, I will not say low quality, there can be conservatism in terms of valuing, right, or in terms of building position. So we had some of the names, maybe the weights were less.
I remember you said the aim of the fund house is to deliver consistent returns. That means like without any significant ups and downs or the volatility. We talked about upside, and coming to the downside, Neelesh. So how is it that the funds from Mirae would perform during any market correction? Do you say that because of the quality of the stocks that the fund house is owning, will it fall lower than other companies?
No, I can't compare with others. We can look at the benchmark. The attempt conceptually is to weed out weaker businesses, right? Weaker management, and not overpay for it. Or these are the three things is an attempt vis-a-vis the benchmark constituent. If that be the case, whenever there are drawdowns, generally the weaker businesses will fall more compared to the stronger. That is the attempt. Despite that, there can be definitely, if the market falls, the funds will sort of fall. And that's the sort of approach that if you are buying quality, then even if they fall, they will recover fast.
Got it. Understand. I think so far we've covered most of the aspects of your style and the performance of the funds as well, Neelesh. Maybe quickly, I mean, where do you invest your personal money?
No, so my money mostly in equities, and mostly within equities, whole of it is in our Mirae funds, equity funds.
Understand. For someone who is, I mean, as I said, we started this discussion saying that this is as if I am a new investor in the market. What are your suggestions? You've been in the industry for such a long time. What are your suggestions for someone who is entering into this field of investing, either as a career or as a process of building their wealth? What is it that's something that they have to remember?
See, this profession of equity research, fund management is very exciting as well as very challenging, because you also constantly beat the benchmark, peers, etc. But I think at a broader level, the task to assume ownership of someone else's wealth, that fiduciary aspect, and compound it over a period of time is very satisfactory. So my view is to someone who wants to enter this line as a profession is try to do it if you are passionate. Others will follow. The commercial aspects will definitely sort of follow. But I think it's most important is if you enjoy the pressure, you can enjoy the ups and downs, or take the pressure only if you are passionate.
And your role model, or who do you look up to in investing?
No, so most of the people probably you would have spoken to, I mean, in terms of role model of what shaped or how do you, in initial years, is obviously Mr. Warren Buffett and his books, and those are timeless in terms of they give a lot of clarity. It's not how many books you have read, it's like one single book, how are you following some of the principles. So yeah, that has really helped most of us in our profession. Yeah.
Are there any other investing books that you recommend?
Yes, as an analyst, I would recommend a very old book by Phil Fisher. It's called Common Stock and Uncommon Profits. And I think it was probably published in 50s or so, late 50s. But it's still, the longevity of that book is there in sense it instills the rigor of research. And he talks about scuttlebutt sort of analysis, look beyond numbers, talk to a lot of ecosystem, channel partners, etc. So if someone who's starting, as if you want, you've set the context, someone who wants to enter research line or as a research analyst, I think it's a very nice, very interesting book. Yeah.
Got it. And lastly, Neelesh, what is your way of giving back to the society?
Yeah, I mean, I do obviously believe that it's very important to give back to the society, and also believe that we are slightly spoiled in the financial world. Before my MBA, I was an engineer, and as an engineer, of course, the commercial aspects are very different compared to we are lucky to be in financial industry, which is very well playing. So you have to obviously get back. I do believe in that from beginning. As a percentage of tax or so, I just have some formula. But beyond that, I think this charity, whether in terms of time or money, I think it's better. What I have read is left hand should not know what right hand is doing. So you have to be slightly conservative.
Well done, well done. Thank you so much, Neelesh. It's been really wonderful talking to you, and I hope this session has been really insightful for a lot of investors who are investing not just in your mutual fund, but also the newbie investors who wanted to learn about markets and gain more insights from your style of investing. Thank you so much. Thank you.